So before we dive into this segment, I want to give a shout out to Paul Krugman, who his ability to to say things that are just outlandish and insane, never ceases to amaze me. One of the things that I forgot he said was that the internet was going to fade and it was going to have the same benefit as the fax machine did. And this was before even before the fax machine became as big as it was. So again, his comments have been, "Oh, inflation isn't that bad if you take out food, energy, housing." What was his other one? Healthcare. It's like, so everything that, and it's funny because he said this, and then I went to my personal spending, and he essentially took out 75% of my budget, and it's like, well, I guess if you take out 75% of my budget, like that makes sense. Like, so I don't know. But, when we look at where inflation is right now, we want to be realistic and not foolish in terms of some of these commentaries. So when we look at the small business expected credit conditions, that's fallen again, which is going to be a kind of a key piece when you look at that pull down and slowdown of underlying inflation. Pricing components within the small business optimism starting to show signs of some stabilization, and percentage seeing higher prices and expecting to raise prices have seen some near-term bounces. So again, you're starting to see that stabilization, and small businesses is a huge part of the economy. And if they're seeing kind of prices going up or staying here, and if you go back through 2000, it's at a very high level. So realistically, where are prices going to fall? If anything, they're still trending to the high side. Now, when you start looking at PPI, remember, PPI is producer price index. It typically leads consumer price index 2 to 3 months. So when you look at some of these stagnating levels and then actually slight reacceleration, well, some freight price components of PPI have firmed. All are obviously down from the peaks, but when you look at pricing, a lot of that is from diesel. A lot of that is from, some additional hiring that had to happen to keep things moving. And realistically, a lot of unions are tied to inflation, and inflation's going up. Therefore, union wages go up. So there's a lot of this problematic standpoints when you look at some of these movements. Then when you look at no major improvement in CapEx plans from the manufacturing side from the Empire. So it's like you're getting the stagnating side on CapEx, but you're getting, and a lot of times it's because you're going to get people let go as they try to, pay the higher price and then wait or try to recoup it on that lag time between when they paid for it. So a company can't receive a higher price and instantly raise prices because they already have orders, they already have a backlog, and they can't turn around and say, well, that backlog is now more expensive. There's some of that in contracts. I'm not saying it's impossible, because there are some things that are pass-throughs, but it typically takes time for those companies to recoup their prices, which is why prices go up like up like an elevator, down like a feather, because of that timing delay for people to, again, recoup the losses or that outlay. CPI consumer on the consumer side. So CPI was expected to be 0.3, came in at 0.4. And this is what we've been saying, is that we see that pressure to the upside. Core was expected at 0.3, came in at 0.3. But again, when rounding, it's the largest jump since May. You're starting to see that bounce back up. September CPI, when you look at it year on year, came in at 3.7% versus the estimate of 3.6. Core came in at 4.1 versus the estimate of 4.1. So you're still seeing, going back to 1990, you get an idea of just how high this is, especially when you look at the core side. And as you start getting that top line bouncing back up, that's going to, again, pause that decline in that core, especially when you look at the month on month and how that continues to drive things higher. When you look at increases, motor vehicle, which has started to get a bit better, but rent, owner's equivalent, food away from home, hospital services. So that's why I find it funny when you hear Krugman say, well, I'm taking away, shelter, food, healthcare services. I'm taking away motor vehicles. It's like, so you're essentially taking away, the top 4 or 5 things, and you're surprised to see. So again, it's just, Excuse me. It's just the absurdity of the comment that gets me every time. Now, when you look at the CPI select categories, you can see fuel oil, gasoline, that month-on-month increase will come down. We've seen that adjust. Hospital services, electricity likely won't. And that's going to be, again, a much bigger problem in general. But fuel oil, gasoline is going to continue to be the upward trend. But when you look at that, again, that PPI side, there was a big pop in the consumer goods portion of PPI. 3-month annualized gain has shot back up to a positive 19%. And again, when you look at that, and this is going back to 1990. By they I mean the Fed wants to see this drop down. It's not. It's actually reaccelerating to the upside, which again is going to end up in the CPI because a company isn't going to look at that and try to push down prices. Eventually, the consumer isn't going to do it, and then that's when the company sees their margins getting hit. But given some of the high-level data, we're not seeing too much of a shift in general. Consumer foods portion of September PPI inflation jumped up in September, came in at 0.9%. Monthly gain was the largest increase since last November. And again, when you look at consumer foods, this is a huge problem when you look at month on month, when you look at the global market, not just the US, because we can feed ourselves. So if we're seeing our prices go up, well, what does the international market look like for people that have to import wheat, import corn? Again, this is going to be passed through and create more pressure and more strife. September industrial production came in at 0.3 versus the estimate of 0. Not too much change one way or the other, as we've been kind of highlighting that we don't see that bigger issue. And this is just putting them together in terms of PPI final demand for services and goods. Services isn't the same level of increase, the goods side, but they're both still positive. Again, all of this is showing that reacceleration. Finished goods portion of PPI starting to rebound, that 2.5%. Still seeing a lot of that upward trend. Now, when you look at it month on month, September PPI came in at 0.5 versus the estimate of 0.3. Core came in at 0.3 versus the estimate of 0.2. All of which the Fed does not want to see. So again, this is all showing that we're moving in the wrong direction, which is why Powell today came out and said, we have to stay in front of this. We have to stay aggressive. They are trying to keep this under their, within their control, because they are continuing to lose control of it. Owner's equivalent rent portion of CPI reaccelerated in September, taking the 3-month annualized gain up to 5.8%. Wholesale inventory sales ratio rolling over. So again, you're seeing the people, buying slowing, but again, shelter's going up. And this is something where they're trying to pull down that shelter price, trying to cap that as they continue to see this moving higher. CPI core services ex housing has reaccelerated over the past handful of months. You saw a bounce in 0.6% in September. It was the largest since 2022. Year-on-year change in CPI core goods fell to 0%, but core services, it eased to 5.7, but still on that higher end. But then if you factor in PPI, well, PPI is going to pull that CPI goods higher. And again, there's a lot of staying power in the service side, especially when you look at CPI core services. That reacceleration is going to take time because, again, the comps are still a little bit easier, but they get harder over time. And as that, you're going to see that reacceleration and that pinch point, which again, the Fed is trying to slow, because otherwise you're going to see a wage price spiral. You're going to see a lot of those pressure points moving up. 3-month annualized gain in core CPI ticked back to 3.1% in September. August wholesale sales quite strong at 1.8% versus the estimate of 0.4. Again, inventories came in at negative 0.1 versus negative 0.3. So still some of that back and forth that remains in the system. Atlanta wage tracker came down slightly into 5.2%. Still fast relative to history, but again, the bigger issue is you're getting wages falling, which is what they want, but you're actually getting inflation going back up, which again is going to become a much bigger issue and as we've been saying, pinch point for spending. And you're starting to see that lowest and highest converge. But remember, the lowest paid individual needs the most amount of money because inflation hits them the hardest. So that's where we're going to see some of that bigger pressure as it gets pulled lower. Then when we turn over to switching jobs, it's no longer paying off like it used to. So you are seeing that slowdown. That is a good thing when you look at the wage force and when you look at new entrants. So the Fed wants to see new entrants because as new entrants come in, that'll inherently make unemployment look worse. And as people slowly stop switching jobs, you're starting to see, again, that cool down that the Fed is looking for, but we still have ways to go in order to get unemployment where it is. Because when you look at their dual mandate, employment and inflation, they're failing on both fronts, and they still need to get in front of that. So then when we look at Empire State, so October Empire Manufacturing Index back in contraction at negative 4.6% versus negative 6%. It's volatile, but as we've been saying, the trend is still negative, and that's the important piece to watch. New orders fell sharply into contraction, and that's especially the outlook, which again is that leading indicator showing that things are not improving. And then when you look at total existing home sales versus the bank rate U.S. mortgages, you get an idea that in the past there were blips. Like as you saw in 2020, there was a blip. As you saw in 2018, there was a blip. Here the gap is so wide that you're going to have to see that pull down, and you're naturally going to see that movement, especially as these new homes, these new apartment complexes come online. When you look at has year-on-year trend in wholesale sales troughed, and if so, what do we see here? So again, wholesale activity is going to kind of balance out, especially as we go into year end and the holiday season. But then there was no meaningful move higher in the percentage of small businesses saying it's a good time to expand. So that's where it's like you're in this kind of holding pattern. And as rates stay higher and it's harder to borrow, you're likely going to see this, again, trough and trend lower. Not trough, but actually start to trend a bit lower. Consumer sentiment missed estimates on, it was expected at 67, came in at 63. Expectations 65.7, came in at 60.7. Again, all of that is going to continue to pressure to the downside. Current financial situation versus a year ago, back to the lows, while inflation expectations bounced. All of this, again, just a reaction to what we've seen in the market. So not surprising from that perspective. Inflation expectations for the 1 year versus the 3 to 5, 10-year outlook continues to trend higher, which again is going to be a continuous problem when you look at what the Fed is trying to accomplish. Consumer sentiment, as we showed, has been trending down, and it still remains in those levels that we saw in 07, 08, 09. But what we said is it gets to a point and then it just kind of goes sideways. And that's where we sit. Could it go lower? Yes. But realistically, whether it goes much lower, it isn't a huge adjustment given what we've already seen, given leading indicators and the like. Number of multifamily housing units under construction near record high, but has been falling over the past couple of months, as it should, because again, there's so much already being constructed. How are we going to continue to add to that? September existing home sales came in at negative 2% versus the estimate of 3.7, level now at the lowest since October 2010. So again, it's going to be difficult to buy a home, especially when you look at rates coming in at 8%. Housing supply crunch still with us, as a spread between units completed and units under construction remains in negative territory. And until we get a meaningful flip in the housing completion, you're going to continue to see some of these stress points. September housing starts came in at positive 7% versus the estimate of up 7.8%. Permits came in at a negative 4.4 versus the estimate of 5.7. So again, there's that back and forth. But when you look to the right, 30-year mortgage rates are at 8%. That is a huge hurdle for people to come into, which is why if you're getting new homes, housing starts, that's a good thing because, again, you're going to need these additional homes to help kind of cool off that pricing. But what is going to be the cost of the builder, and how are they going to try to essentially cordon off and try to protect against some of these various rate hikes? So here, when you look at home buyers need to earn $115,000 to afford median-priced U.S. homes more than ever before, you get an idea of the pressure points, and then the MBA U.S. Purchase Index at the lowest level going back to 1995. that's going to hinder the ability of people to come in and buy, which again is going to pull down a lot of those prices. Now, when we look at home buyer affordability, same thing. When you look at that 8%, going back to the 1980s, it's the least affordable time to have a home. When we go back further, you can see that it actually is equivalent to 1985, 86, to give you an idea of just how bad and how problematic the current market is. So it's not surprising for University of Michigan, buying conditions for a vehicle, terrible. Buying conditions for a house, terrible. Household durables, slightly better, but then when you look at, again, the housing permits, we typically see a bit of a trough. You could see that where it is in accordance to historics. Then when you look at the value of a house as interest rates change, in terms of the down payments, the pressure continues to mount. Home builder average pre-tax margin, this is what we see in general in terms of some of that pressure point, is as that margin diminishes, you're going to get more pressure. You're going to see that margin really continue to be that problem as you see, again, what is the new build? If they're new build, what does that look like? So then when we look at not much improvement for how consumers feel about housing market, consumer inflation expectations for the next year jumped considerably, which again is not surprising, which is why when you start looking at housing market index, much weaker for the NHA Home, Builders Home Association, expected at 44, came in at 40. All components declined with future sales outlook falling the most, which again is that when you look at the traffic is dropping off, slowdowns are there, which again is going to lead, and we're going to see that bigger drop in underlying home sales, which is again going to pull down pricing. So that's what we have here on the U.S. side. In the next segment, we're going to go into Europe and a lot of the things that are happening in the European world.